When people hear the word liability, they often think of debt. But in business, liabilities are broader than that. A liability is any obligation a company owes to someone else. It can be money, services, or something the business must deliver in the future. Understanding liabilities is important because they show what a company owes and help reveal its true financial position. The first major type is current liabilities. These are obligations due within 1 year or within the company's operating cycle. Common examples include accounts payable, wages payable, taxes payable, and short-term loans. If a business buys supplies on credit, that unpaid amount becomes an account payable. Current liabilities matter because they affect cash flow and day-to-day operations. A company can look profitable on paper, but if it cannot cover its current liabilities, it may struggle to stay afloat. Next are long-term liabilities. These are debts or obligations that are due after 1 year. Examples include bank loans, bonds payable, lease obligations, and pension liabilities. Businesses often use long-term liabilities to finance growth, buy equipment, or expand operations. While they can help a company grow, they also create future payment commitments that must be managed carefully. There are also contingent liabilities. These are potential obligations that depend on a future event. A lawsuit is a common example. If a company is being sued, it may or may not have to pay damages depending on the outcome. Product warranties are another example, because the business may need to repair or replace defective products later. Contingent liabilities are important because they create uncertainty, and investors pay close attention to them. Another useful way to think about liabilities is by whether they are secured or unsecured. Secured liabilities are backed by collateral, such as a building or equipment. If the business fails to pay, the lender can claim the asset. Unsecured liabilities do not have collateral backing them, so they rely more on the company's creditworthiness. These differences affect risk for both the business and the lender. In short, business liabilities come in several forms: current, long-term, contingent, secured, and unsecured. Each one tells a different part of the financial story. By understanding them, business owners can manage risk, plan for payments, and make smarter financial decisions.